The global settlement system just changed. Most people don't know it yet. 3 days ago, Mastercard confirmed it is integrating RLUSD, Ripple's stablecoin, into live card transaction settlement. Not a test, not a concept paper, operational settlement, on a network that touches billions of transactions daily. What that quietly signals about the $27 trillion sitting frozen inside the correspondent banking system right now, and what it means structurally for XRP, is what this video is about. And I want to be precise because precision is the only thing that separates useful analysis from noise. Before we go further, nothing here is financial advice. This is educational analysis based on publicly available BIS data, institutional filings, and documented commercial deployments. Do your own research. Consult a qualified professional, always. If this channel earns your attention by going deeper than the headline, hit the like button and subscribe. What's coming in the next 12 weeks makes it worth having notifications on. Let's get into it. The problem being solved is not what most people think it is. When institutions describe the inefficiency of cross-border payments, they reach for the word slow. That's accurate but incomplete. The deeper problem is capital immobilization. The BIS, the Bank for International Settlements, the central bank of central banks, estimates that approximately $27 trillion is pre-positioned in nostro accounts globally at any given moment. These are funds that financial institutions are required to park in advance, in every currency corridor they operate, simply to guarantee that when a payment instruction arrives, there is liquidity available to honor it. The capital is not earning meaningful returns. It is not being deployed into productive assets. It exists purely because the settlement infrastructure was designed in an era when moving money across borders took days, and you needed to hold reserves against that delay. Ripple's on-demand liquidity replaces that model architecturally. Instead of pre-funding, the institution sources XRP as a bridge asset at the exact moment of the transaction, converts on both sides within 3 to 5 seconds, and completes settlement. The pre-positioned capital is freed. It can remain productive until the precise moment it is needed. That is not an upgrade to the existing system. That is a structural substitution of one model for another. And Mastercard, operating at the scale of billions of annual transactions, has now moved its settlement architecture in that direction. The decision at that scale is not reversed. Settlement infrastructure is not rebuilt twice. When a network of Mastercard's size chooses a settlement layer, that layer acquires a transaction footprint that compounds over time. Now, the mechanism most coverage is missing entirely. RLUSD is issued on the XRP Ledger. Every transaction on the XRP Ledger consumes a small amount of XRP in transaction fees. Those fees are not collected. They are burned, permanently removed from circulating supply. This is the documented fee architecture of the XRP Ledger. It is code, not policy. At current RLUSD volumes, the fee burn is modest. At Mastercard's transaction volume, billions of annual transactions, the burn rate scales directly. Every RLUSD settlement on Mastercard's network reduces XRP's circulating supply automatically. No decision required from Ripple, from Mastercard, or from anyone. The relationship between RLUSD adoption and XRP supply compression is mathematical, not narrative. Simultaneously, every active ODL corridor requires participating institutions to hold XRP in operational liquidity pools. That supply does not re-enter speculative trading for the duration of the corridor's activity. Two distinct demand channels, fee burn reducing supply, operational reserves locking float, both activated by the same integration. This is why the Mastercard announcement is structurally significant for XRP beyond sentiment. Volume growth on RLUSD compounds directly into supply reduction. The mechanism runs independently of market cycles, the competitive dimension. Mastercard's move does not exist in isolation. It initiates a decision sequence across every competing network. Visa processes approximately 200 billion transactions annually. American Express, UnionPay, and the major regional networks handle billions more. If Mastercard's settlement layer delivers documented cost and efficiency advantages at scale, each of those networks faces the same binary choice: match the infrastructure or accept a compounding cost disadvantage in every corridor where Mastercard has deployed it. Financial infrastructure history is consistent on this point. When SWIFT introduced electronic messaging in the 1970s, adoption across global correspondent banking took approximately a decade, driven entirely by competitive pressure, not regulatory mandate. The pattern repeats without exception. One major institution moves. The decision clock starts for every peer simultaneously, and the clock runs faster than it appears, because network effects amplify the early mover's advantage the longer competitors wait. Mastercard has started that clock. The response from Visa and the rest of the network is a matter of when, not whether. The Pakistan corridor, macro connecting to operational reality. Pakistan recently reversed its standing prohibition on crypto-based financial infrastructure. The significance is specific, not symbolic. Pakistan receives approximately $27 billion in annual remittance inflows, one of the largest remittance markets in the world, primarily from diaspora populations in the Gulf Cooperation Council, the United Kingdom, and the United States. The GCC to Pakistan corridor carries average fees consistently above the global 6.3% benchmark documented quarterly by the World Bank. It is among the highest volume, highest cost corridors in the global remittance system. One of Pakistan's largest commercial banks is already connected to RippleNet. The infrastructure relationship exists. The regulatory barrier has been removed. Deploying ODL in the Pakistan corridor is now an operational decision, not a development decision. When it activates, the World Bank's third-party database will document the fee reduction, and that documentation becomes the evidence standard that other high remittance volume markets use to evaluate opening their own regulatory frameworks to the same infrastructure. Pakistan does not happen in isolation. It is a data point with downstream effects across every comparable market watching the outcome. The sovereign finance dimension. $28 trillion in U.S. Treasury bonds mature by 2028. Annual federal tax revenue runs approximately $5 trillion. The arithmetic of that maturity wall requires the most liquid, most operationally efficient Treasury market infrastructure in American financial history to navigate without a systemic stress event. The BIS, in its Project Agora blueprint and in its 2025 annual economic report, has outlined a next-generation financial system in which tokenized central bank reserves, tokenized commercial bank deposits, and tokenized government instruments settle on a unified programmable ledger with atomic finality. The settlement infrastructure that supports tokenized sovereign debt at the scale of $28 trillion in maturities requires exactly what the XRP Ledger was built for: deterministic finality in seconds, institutional-grade reliability, and transaction costs that remain low at global volume. Ripple participates in the BIS Committee on Payments and Market Infrastructures, the body currently writing the technical standards that will govern that infrastructure. The standards established now determine which settlement layer handles sovereign instruments when tokenized treasury operations scale from pilot to operational. Participation in that standards process is not incidental. It is the outcome of a deliberate, decade-long positioning within the institutional infrastructure of global finance. The complete picture. Mastercard's RLUSD integration is live settlement deployment on a network processing billions of transactions, going live in the first half of this year. The architectural relationship between RLUSD and XRP means that volume growth on the Mastercard network directly compresses XRP's circulating supply through a mechanism built into the ledger's code. The $27 trillion in idle nostro capital is the market being structurally disrupted. The competitive cascade has started the decision clock for every major payment network simultaneously. Pakistan's regulatory shift creates an immediate high-volume ODL corridor activation opportunity where the infrastructure connection already exists. And the sovereign finance dimension, tokenized treasury settlement governed by technical standards that Ripple is actively helping establish, represents the institutional demand layer that current XRP valuation models have not incorporated. The leading indicators that matter here are not the weekly price chart. They are the RLUSD transaction volume curve, the ODL corridor activation rate, and the institutional ETF flow ratio, all of which move before the price does. If this gave you the complete picture, the $27 trillion mechanism, the fee burn architecture, the competitive cascade, the Pakistan corridor, and the sovereign finance layer, the like button is the signal that this level of analysis is worth continuing. Share this with one XRP holder who saw the Mastercard headline and moved on without understanding why it matters structurally. Subscribe with the bell on. The RLUSD go live date, the Pakistan corridor activation, and the Clarity Act window are all converging in the same calendar window, and when any of them moves, the analysis is here within hours. Tell me in the comments, which institutional response do you expect to come first? Visa integrating stablecoin settlement infrastructure, or a G20 central bank formally announcing an ODL deployment through an existing RippleNet partner? See you in the next one.